Welcome to the Daily Update Podcast, where I'll go over the action in the market for Wednesday, October 15th, and we'll see how things look for Thursday, October 16th. Going over Wednesday's market action. The S&P closed Wednesday with a modest gain, edging up 0.4%. However, it was a day of mixed signals, with the index struggling to hold above its 20-period moving averages and ultimately closing just shy of that key technical level. The S&P 500 opened strong, briefly surpassing the 6,700 mark and hitting an intraday high at 6,725. But resistance kicked in and the index fell back below 6,700, finding support at the daily pivot at 6,627. Late day buying helped it recover slightly, closing just below 6,675. Key levels of note: 6,725 acted as firm resistance, likely influenced by algorithmic trading at that round number. Support held at the 50-period moving average even though it went untested on Wednesday, providing a bit of a cushion for the S&P. Volume, however, was below average, signaling mixed sentiment and a lack of strong conviction among investors. Volatility remains elevated, with the VIX above 20 at 20.64. There's a continued increase of the VIX of VIX, reflecting ongoing uncertainty in the market. Sector performance was uneven. Tech and communication led the way, with standout gains from Apple and Google. Meanwhile, energy, industrials, and materials lagged. Small caps, however, outperformed, climbing nearly 1%, hinting at some rotation into riskier assets. Earnings reports painted a mixed picture as far as the results. Morgan Stanley and Bank of America posted gains, while PNC and Progressive saw declines. On the economic front, the Empire State Manufacturing Survey surprised to the upside at 10.7, well above expectations of a minus 1.8. However, the MBA Mortgage Applications Index fell 1.8% for the week, a smaller drop than what was experienced last week. The Beige Book, released near the close, showed little change in economic activity. Geopolitical and policy developments also weighed on the market. Early optimism about a potential U.S.-China trade truce faded after the opening bell, contributing to selling pressure. Treasury Secretary Bessent's comments urging defense contractors to prioritize R&D over stock buybacks for national security added to the noise. Meanwhile, the 10-year Treasury yield ticked up to 4.05% from 4.02% after testing the critical 4% level. A break below 4% could really help stocks, while further gains might add pressure. Gold continued its rally, serving as a hedge against inflation and what some are calling geopolitical insanity. Sentiment indicators, like the weekly Investors Intelligence Bull-Bear ratio, remains elevated, suggesting potential over-optimism. Gamma exposure points show resistance at 6,750 and support between 6,600 and 6,625. Looking at the technicals and market breadth. Short term, the S&P is showing a negative bias, largely due to its inability to close above the 20-period moving averages. Momentum indicators are mixed. Some, like the Vortex, which is intermediate term, has turned positive, while others, including the MACD and PMO, are trending lower. However, intermediate and long-term trends still remain positive. Growth stocks slightly outperformed value, but ratios indicate short-term weakness. Small caps are starting to shine, with the small cap to large cap ratio recently producing a golden cross. Market breadth is holding up, with the advanced decline line stable but not hitting new highs. Smart money indicators are mostly negative. Accumulation distribution in the longer term is positive, but the Chaikin money flow and oscillator are negative. Looking ahead to Thursday, October 16th. The short-term bias remains negative due to resistance at the 20-period moving averages. But support above the 50-period moving average is keeping the S&P in a defined range between 6,600 and 6,625 on the downside and 6,700 to 6,750 on the upside. Seasonal trends offer some optimism. Historically, October 16th has been positive, and we are in options expiration week, which has been up 73% of the time since 1980. That said, the second half of October tends to be less robust than the first half. No major economic reports are expected due to the ongoing government shutdown, but earnings reports will continue. though the companies that are reporting earnings are still in blackout periods to announce new buybacks. Geopolitical factors, particularly U.S.-China trade dynamics, will likely keep investors on edge. In the longer term, there are two technical signals to keep an eye on. A potential Hindenburg-Ullman confirmation by November 7th, which is negative, and a ZWAG NYC breadth thrust, which needs to be confirmed by October 24th, which is positive. In conclusion, the S&P 500 is navigating a tricky short-term landscape, caught between resistance to the upside and support to the downside. Mixed economic signals, geopolitical uncertainty, and below-average volume do call for caution. Also, it's best to keep an eye on small caps and gold as they are receiving lots of attention. Intermediate and long-term trends remain positive, so investors with a longer horizon may find opportunities amidst the current noise. Thank you very much, and I will talk to you in the next podcast.